Good morning. If you've been watching the financial markets lately, you've noticed something unusual happening with silver. Not the dramatic headlines, not the social media hype. Something deeper. Silver is behaving differently than it has in decades, and most investors are completely unprepared for what this means. Today, we're going to discuss why silver has moved from the background of financial markets to center stage. We're going to examine what's driving this transformation, and most importantly, we're going to discuss what you should actually do about it. This isn't about getting rich quickly. This isn't about jumping on trends. This is about understanding a fundamental shift in how one of the world's oldest monetary metals is being valued, traded, and positioned in portfolios worldwide. Whether you currently hold silver or you're considering your first position, the next 25 minutes could reshape how you think about this market. Let's begin. Silver occupies a unique position in financial markets. It's simultaneously a monetary metal, an industrial commodity, and a store of value. This triple identity creates dynamics that most other assets simply don't experience. For the past decade, silver has largely been overlooked. Investors focused on technology stocks, cryptocurrency, and traditional safe havens like gold. Silver sat quietly in the background, trading in predictable ranges, generating little excitement. That predictability is ending. Several structural forces are converging on silver simultaneously. These aren't temporary factors. They're long-term trends that will reshape the market for years to come. First, industrial demand has accelerated beyond anyone's projections from just 5 years ago. Solar panel production alone now consumes nearly 20% of annual silver supply. Electric vehicles require significantly more silver than traditional automobiles. Electronics manufacturing continues expanding globally. This isn't speculation. This is happening right now in factories across the world. Second, the supply situation has become increasingly constrained. Major silver mining operations take years to develop. Existing mines are aging. Discovery rates for new deposits have declined, and silver is rarely mined on its own. It's typically a byproduct of copper, lead, and zinc mining. When those base metal operations slow down, silver supply contracts. Third, monetary policy across major economies has created an environment where hard assets are receiving renewed attention. After years of unprecedented money creation, investors are reassessing what actually holds value during periods of currency uncertainty. Silver benefits from this reassessment. But here's what makes the current moment distinctive. These three forces aren't taking turns. They're all intensifying at the same time. To understand where we are, we need to understand where we've been. Silver has a 5,000-year history as money. For most of human civilization, silver was the primary medium of exchange for ordinary commerce. Gold was for kings and large transactions. Silver was for everyone else. That changed in the 20th century. Governments systematically removed silver from monetary systems. The United States eliminated silver from most coins by 1965. Other nations followed similar paths. Silver transitioned from money to commodity. This created a strange situation. Silver retained its psychological status as a monetary metal, but traded primarily on industrial fundamentals. For decades, this worked reasonably well. Then came the 1980 peak. Silver briefly touched $50 per ounce during a period of extreme monetary instability and speculative buying. That peak became a reference point and a warning for an entire generation of investors. Silver spent the next 2 decades in decline. By 2001, it had fallen below $5 per ounce. An entire generation of investors learned that silver was volatile, unreliable, and dangerous. The 2000s brought a new bull market. Silver climbed from under $5 to nearly $50 again by 2011. This rally was driven by post-financial crisis monetary expansion, Chinese industrial demand, and investor concerns about currency debasement. Then came another painful correction. Silver fell back below $14 by 2015. Once again, investors who bought at the wrong time experienced devastating losses. This volatility created a reputation. Silver became known as the asset that promises wealth but delivers pain. But something has shifted since that last bottom. The current move in silver isn't driven by speculation alone. It's not primarily about traders chasing momentum. The foundation is different this time. Additionally, the investor base has matured. Today's silver buyers are more likely to be institutional investors, family offices, and strategic allocators. They're not gambling on quick returns, they're positioning for long-term portfolio protection. History doesn't repeat perfectly, but it often rhymes. The pattern we're seeing now resembles the early stages of previous major silver cycles, but with stronger fundamental support than we've seen before. Every market moves through predictable psychological phases. Understanding where silver sits in this cycle matters enormously for your decision-making. The cycle begins with the bottom. Prices are low. Sentiment is terrible. Nobody wants to discuss the asset. Media coverage is minimal or negative. This is where long-term value is established. Silver reached this phase around 2020. Prices had been depressed for years. Most investors had given up. The few bulls remaining were exhausted. Then comes the early bull phase. Prices start rising, but most observers dismiss it as a temporary bounce. Skepticism remains high. Media coverage is still minimal. Early buyers are criticized for chasing a failed asset. We've moved through this phase over the past few years. Now we're entering what I call the recognition phase. This is where the broader market begins acknowledging that something real is happening. Media coverage increases. More analysts issue positive reports. Institutional interest builds. This is approximately where we are today. What comes next in a typical cycle? The acceleration phase. Prices rise more rapidly. Excitement builds. New investors enter the market. Stories of quick profit circulate. This is where markets typically overheat. We haven't reached that phase yet with silver. Eventually comes the mania phase. Prices disconnect from fundamentals. Everyone you know is buying. Taxi drivers offer investment tips. Celebrities promote the asset. This is where serious investors begin exiting. We're nowhere near this phase currently. Understanding this progression is critical because your strategy must adapt to each phase. The biggest mistake investors make is applying early cycle thinking to late cycle markets, or late cycle thinking to early cycle markets. They buy aggressively when they should be cautious, and they sit on the sidelines when they should be accumulating. Where silver sits today in the recognition phase presents specific opportunities and specific risks. The opportunity is that significant upside likely remains before speculation takes over. The fundamental drivers are strong. Industrial demand continues growing. Supply constraints are real. Institutional accumulation is accelerating. The risk is that we're no longer at the absolute bottom. Buying silver today requires accepting that you're not getting the best possible price. You're trading perfect entry timing for strong fundamental support. This is actually a favorable trade-off for most investors. Trying to buy at absolute bottoms means you'll often miss entire cycles, waiting for prices that never return. Buying during the recognition phase means accepting slightly higher prices in exchange for confirmation that the trend is real. Now, let's discuss what typically goes wrong. Silver attracts a particular type of investor psychology that often leads to poor decisions. First, there's the binary thinking trap. Investors treat silver as either the answer to everything or completely worthless. They become true believers or absolute skeptics. Reality is more nuanced. Silver is a useful portfolio component. It provides exposure to industrial growth, monetary uncertainty, and commodity cycles. It's not a magic solution. It's not worthless. It's a tool. Second, there's the timing obsession. Investors spend enormous energy trying to identify the perfect entry point. They wait for pullbacks that never come, or they panic and buy at local peaks. This constant timing focus creates anxiety and often leads to worse results than simple, disciplined accumulation. Third, there's the leverage temptation. Silver's volatility attracts traders who want to amplify returns through futures, options, or leveraged products. This rarely ends well for individual investors. Professional traders have sophisticated risk management, instant access to markets, and the emotional discipline that comes from treating trading as a business. Individual investors trying to replicate this typically lack all three advantages. Using leverage transforms silver from a strategic portfolio holding into a speculative bet. The mathematics of leveraged positions means that even if your long-term thesis is correct, short-term volatility can eliminate your position before the thesis plays out. Fourth, there's the herd mentality. When silver starts moving, online communities become echo chambers of excitement. Everyone shares stories reinforcing bullish narratives. Dissenting opinions are dismissed. This environment makes rational decision-making extremely difficult. Fifth, there's the emotional attachment. Investors develop personal connections to their silver positions. They start identifying as silver investors, rather than simply people who own some silver. This identity makes it nearly impossible to exit when circumstances change. These psychological traps are predictable. They appear in every silver cycle. Awareness doesn't make you immune, but it does give you a fighting chance at avoiding the worst mistakes. Now let's examine the fundamental drivers in detail. Industrial demand for silver has transformed dramatically over the past decade. Solar panel manufacturing now represents the fastest growing segment of silver consumption. Each solar panel requires approximately 20 grams of silver. As solar installations accelerate globally, driven by both environmental concerns and economic competitiveness, silver demand increases proportionally. Current projections suggest solar demand could double over the next 5 years. These aren't optimistic forecasts. They're based on installations already planned and manufacturing capacity already built. Electric vehicles present another structural demand source. A typical electric vehicle contains between 25 and 50 grams of silver, compared to 15 to 28 grams in conventional vehicles. As global automotive production shifts toward electric, this creates persistent incremental demand. Electronics manufacturing continues consuming substantial silver for conductors, switches, and contacts. This demand is less dramatic than solar or electric vehicles, but it's steady and growing with global economic development. Medical applications, water purification systems, and specialized industrial uses add further demand. Here's what matters. These industrial applications are relatively price insensitive. Solar manufacturers need silver for conductivity. There's no adequate substitute at current technology levels. If silver prices rise 20 or 30%, solar panels still get built. The silver cost is a small fraction of total panel cost. This creates inelastic demand that persists even as prices rise. Compare this to investment demand, which is highly price elastic. When silver rises, some investors sell to take profits. When it falls, some buyers emerge looking for bargains. This creates natural market balancing. Industrial demand doesn't balance the same way. It just keeps coming day after day, regardless of price. This is a fundamental shift from previous silver cycles, where investment demand dominated price movements. Supply dynamics in silver markets are widely misunderstood. Many investors assume that if prices rise, mining companies will simply produce more silver. This assumption is dangerously oversimplified. Silver is rarely mined as a primary product. Roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This creates a strange situation. And when copper prices are low, copper mining slows down. Even if silver prices are high, silver production decreases because it's tied to copper mining activity. Mining companies make production decisions based on their primary metal, not their byproduct. Additionally, developing new silver production takes years. From initial discovery to full production, a mining project typically requires 7 to 10 years. This includes exploration, permitting, financing, construction, and ramp-up. You can't simply turn on new supply in response to price signals. Existing mines are aging. Many major silver-producing operations are decades old. As mines mature, ore grades typically decline. Companies must process more material to extract the same amount of silver. This increases production costs and often leads to reduced output. Discovery rates for new silver deposits have declined significantly over the past 2 decades. Despite advanced exploration technology, fewer world-class deposits are being found. The easy-to-find silver has already been discovered. Environmental and permitting challenges have intensified globally. Projects that might have received approval 20 years ago now face lengthy regulatory processes and substantial opposition. Even well-funded companies with strong deposits struggle to bring new projects online. Above-ground stockpiles provide some buffer, but these are largely held by investors and industrial users who view their holdings as long-term positions. This silver isn't readily available for sale at modest price increases. The supply situation isn't a crisis, but it's definitely a constraint. When constrained supply meets growing demand, prices adjust upward until equilibrium is restored. This is basic economics. The question isn't whether this will happen, it's how quickly and how far. Silver doesn't trade in isolation. It responds to broader monetary and economic forces. Understanding these forces helps you interpret silver's price movements and position yourself appropriately. Over the past 15 years, major central banks have expanded money supplies at unprecedented rates. The 2008 financial crisis triggered massive monetary expansion. The 2020 pandemic response brought another wave. This expansion creates an environment where hard assets, things that can't be printed, receive increased attention from sophisticated investors. Silver benefits from this dynamic, though less directly than gold. Interest rates influence silver significantly. When real interest rates, the nominal rate minus inflation, are negative, holding silver becomes more attractive. You're not sacrificing yield to own a non-yielding asset. When real rates are significantly positive, the opportunity cost of holding silver increases. We're currently in an environment where real rates are historically low, even as nominal rates have risen. This remains supportive for silver. Currency instability also drives interest in silver. When major currencies experience volatility or steady debasement, investors seek alternatives that maintain purchasing power. Silver has maintained purchasing power over centuries. An ounce of silver today still buys roughly what it bought hundreds of years ago in terms of basic goods and labor. Geopolitical tensions create additional demand for assets that sit outside the traditional financial system. Silver, like gold, isn't anyone's liability. It doesn't depend on government promises or institutional solvency. This independence becomes valuable during periods of institutional uncertainty. Inflation expectations matter enormously. Silver tends to perform well during periods of above-average inflation. It struggles during deflationary periods and during stable, low-inflation environments. Current inflation dynamics are complex. Official measures show inflation moderating from recent peaks, but underlying pressures, energy transition costs, deglobalization, demographic shifts, suggest inflation may remain elevated longer than many expect. Silver benefits from this environment. However, and this is crucial, silver's response to macroeconomic forces is rarely immediate or linear. Markets anticipate, overshoot, correct, and consolidate. Just because monetary conditions favor silver doesn't mean prices rise every day. Patience is required. If you already own silver, you face a different set of decisions than potential buyers. Your primary questions are, Should I hold? Should I add to positions? Should I reduce exposure? Should I exit completely? Let's address each scenario. First, the case for holding. If you purchased silver as a long-term strategic holding for portfolio diversification, monetary insurance, or commodity exposure, the fundamental reasons for that purchase remain valid. Industrial demand is stronger than when you bought. Supply is tighter. Monetary conditions remain supportive. The case hasn't weakened. Holding makes sense unless your personal circumstances or investment objectives have changed dramatically. Second, the case for adding to positions. This requires more careful consideration. Adding to existing positions makes sense if silver remains underweighted in your overall portfolio, if you have new capital to deploy, and if you're comfortable with your average cost basis increasing. The risk is averaging up. If you bought silver at significantly lower prices, adding now means reducing your overall return on the position if prices eventually correct. This doesn't mean you shouldn't add. It means you should be thoughtful about position sizing and avoid letting the excitement of rising prices drive your decisions. A disciplined approach: determine your target allocation to silver based on your overall portfolio strategy. If you're below that target, add methodically. If you're at or above target, maintain your position, but don't chase. Third, the case for reducing exposure. This is appropriate if silver has grown to represent an uncomfortably large portion of your portfolio. If your personal circumstances require more liquidity, or if you believe we're entering a phase where risks outweigh potential rewards. Reducing doesn't mean abandoning silver entirely. It means rebalancing to maintain appropriate risk levels. One strategy: if silver has appreciated significantly since your purchase, consider taking profits on a portion of your position equal to your initial investment. This removes your cost basis from the table and allows you to hold the remainder with zero emotional attachment. Fourth, the case for exiting completely. This makes sense if your investment thesis has been invalidated, if you need capital for higher priority uses, or if silver has become such a source of stress that it's affecting your overall well-being. There's no shame in exiting. Every investment involves trade-offs. If holding silver is causing you to make poor decisions elsewhere or creating anxiety that outweighs potential benefits, exit and move on. Across all these scenarios, avoid emotional decision-making. Don't hold simply because you're afraid of missing additional gains. Don't add because everyone around you is buying. Don't reduce because short-term volatility scares you. Don't exit because someone online predicted a crash. Base your decisions on your personal financial situation, your risk tolerance, your time horizon, and rational assessment of silver's role in your portfolio. One final consideration for current holders: tax implications. In many jurisdictions, silver is taxed as a collectible, often at higher rates than traditional securities. Selling triggers taxable events. Before making major position changes, consult with a tax professional to understand the implications. Sometimes, the right financial decision is holding simply to defer taxes until a more advantageous time. If you're considering your first silver position, you need a different framework. The questions you should be asking: should I buy? How much? In what form? With what time frame? Let's work through each question systematically. Should you buy silver at all? This depends on what you're trying to accomplish. If you're seeking quick profits, silver is probably not appropriate. The volatility works both ways. You could easily buy and watch prices decline 20 or 30% before they resume upward movement, if they resume at all. If you're seeking portfolio diversification, silver offers genuine benefits. It correlates differently with stocks and bonds. It provides exposure to commodity cycles and monetary uncertainty. A modest allocation can reduce overall portfolio volatility. If you're seeking protection against currency debasement or systemic financial instability, silver provides some insurance. It's not perfect insurance. Silver prices can fall even during crises, but it's a hedge worth considering. If you're building long-term wealth through productive assets, silver should be a small part of your strategy at most. Businesses, real estate, and human capital generate returns. Silver just sits there. It doesn't produce dividends, rent, or earnings growth. For most investors, silver makes sense as a 5 to 15% portfolio allocation. Enough to matter if industrial demand and monetary factors drive sustained price appreciation. Not so much that your financial future depends on silver performing well. How should you buy? You have several options, each with distinct trade-offs. Physical silver, coins or bars, provides direct ownership without counterparty risk. You hold the actual metal. No one can freeze your account, change redemption terms, or go bankrupt and leave you as an unsecured creditor. But physical silver requires secure storage, creates potential liquidity challenges, and often involves premiums above spot price when buying and discounts when selling. Exchange-traded funds backed by physical silver offer convenience and liquidity. You can buy and sell instantly through brokerage accounts. Storage is handled professionally. Transaction costs are typically lower than buying physical, but you don't own the actual silver. You own a claim on silver held by a trust. In extreme scenarios, you might face redemption issues. Silver mining stocks provide leveraged exposure to silver prices. When silver rises, mining companies often appreciate more dramatically because their entire business model improves. But mining stocks come with company-specific risks, management quality, operational issues, political risk in mining jurisdictions. You're not just betting on silver, you're betting on specific companies executing their business plans. Silver futures and options offer high leverage and sophisticated strategies for experienced traders. For most individual investors, these are inappropriate. The complexity, margin requirements, and rapid price movements create risks that outweigh potential benefits. My suggestion for new investors: start with something simple. Either physical silver coins from reputable dealers or shares in established, physically backed ETFs. Avoid complexity until you deeply understand what you own and why you own it. Timing your entry requires thought. Dollar cost averaging, buying fixed dollar amounts at regular intervals, removes the pressure of identifying perfect entry points. If you plan to allocate $10,000 to silver, consider buying $2,000 per month over 5 months. This smooths out volatility and reduces the risk of entering at a temporary peak. Alternative approach: buy your full position now if you believe current prices represent value, accept short-term volatility, and commit to holding long enough for your thesis to play out. Either approach can work. What doesn't work is constantly second-guessing yourself, buying a small amount, watching prices move, then buying more in response to momentum rather than strategy. Decide your allocation, decide your purchase method, execute your plan, then step back. Let me be direct about behaviors that consistently destroy wealth in silver markets. First, never invest money you need for near-term expenses. Silver can decline sharply and stay depressed for months or years. If you need to sell during a downturn to cover living expenses, you'll lock in losses at the worst possible time. Only invest capital you can afford to leave untouched for at least 3 to 5 years. Second, never use leverage or margin to buy silver. I cannot emphasize this enough. Silver's volatility will eventually trigger margin calls if you're leveraged. You'll be forced to sell at unfavorable prices, regardless of your long-term conviction. Leverage transforms investing into gambling. Don't gamble with silver. Third, never buy silver based solely on price predictions you read online. No one knows where silver will be next month or next year. Predictions are guesses dressed up as analysis. Buy based on fundamentals, portfolio strategy, and your personal financial situation. Ignore the price predictors. Fourth, never buy silver in a panic during rapid price increases. When silver jumps 20% in 2 weeks, your natural instinct is to buy before you miss out. This instinct is usually wrong. Rapid increases often lead to rapid corrections. You end up buying near local peaks and watching your position decline immediately. If you believe in silver long term, buy during quiet periods when nobody's talking about it, not during frenzies. Fifth, never ignore storage and security for physical silver. Keeping significant amounts of silver in your home creates theft risk and potential insurance complications. If you own physical silver, invest in proper storage, either a quality home safe or professional vault storage. Sixth, never stop monitoring your overall portfolio allocation. Silver's price can move dramatically. A position that represented 10% of your portfolio might grow to 20% or shrink to 5%. Rebalance periodically to maintain your target allocation. This forces you to sell when silver has run up and buy when it's depressed. Exactly the behavior that builds wealth over time. Seventh, never trade silver frequently based on short-term price movements. Every trade creates transaction costs and potential tax liabilities. Frequent trading is a wealth transfer from you to brokers and tax authorities. Buy with conviction, hold with discipline. Sell when your thesis changes or allocation needs adjustment. Eighth, never fall in love with silver. It's a financial tool, not an identity. When the time comes to reduce or exit positions, whether for profit-taking or loss management, you need to be able to execute without emotional attachment. Ninth, never ignore diversification. Silver should be part of a broader portfolio, not your entire strategy. Maintain exposure to productive assets, maintain adequate cash reserves, maintain a balanced approach. 10th, never stop learning and reassessing. Markets evolve, your personal circumstances change. The case for holding silver today might not be the case for holding it 5 years from now. Stay informed, stay rational, stay flexible. Silver doesn't move in isolation. Understanding what's happening in related markets helps you interpret silver's behavior. Gold provides important context. As silver's monetary cousin, gold often leads the way in precious metal cycles. When gold is strong, silver typically follows, often with greater percentage moves in both directions. Currently, gold has shown significant strength, reaching new highs in several currencies. This provides a supportive backdrop for silver. However, silver hasn't moved proportionally to gold. The gold to silver ratio, how many ounces of silver equal 1 ounce of gold, remains elevated by historical standards. This could indicate silver is undervalued relative to gold, or it could indicate that industrial demand concerns are tempering silver's monetary premium. Copper offers another reference point. As a primary industrial metal, copper's price reflects global manufacturing activity and infrastructure spending. When copper is strong, it suggests robust industrial demand that should support silver. Copper has shown resilience recently, supporting the industrial demand narrative for silver. Base metals more broadly, zinc, lead, nickel, influence silver because they affect byproduct silver production. When base metal prices are depressed, mining activity slows, constraining silver supply even if silver prices are favorable. Equity markets matter significantly. During broad stock market declines, silver often falls alongside equities despite its reputation as a safe haven. This reflects forced liquidation and general risk-off sentiment. Understanding this correlation prevents misplaced expectations about silver's behavior during crises. Bond markets provide crucial signals about interest rate expectations and inflation concerns. When bond yields rise rapidly, it often pressures silver. When yields fall or remain stable with rising inflation expectations, silver tends to benefit. Currency markets, particularly the US dollar, have inverse relationships with silver. A strengthening dollar typically pressures silver prices because silver is dollar-denominated globally. A weakening dollar tends to support silver. Recent dollar strength has created headwinds for silver. If the dollar weakens from current levels, it would remove one obstacle to silver appreciation. Cryptocurrency markets have developed an interesting relationship with silver. Both attract investors concerned about monetary debasement and seeking alternatives to traditional financial assets. Sometimes they move together as alternative stores of value. Sometimes they compete for the same investment dollars. Understanding these relationships helps you avoid panicking when silver declines for reasons unrelated to its fundamental outlook. If silver falls because the dollar surged or stocks crashed, that's different from silver falling because industrial demand collapsed. Context matters. Let's zoom out and consider what really matters over extended time frames. Silver has preserved purchasing power over centuries. Not consistently year to year, but over long periods, an ounce of silver maintains its value relative to basic goods and labor. This preservation is silver's fundamental promise. Not wealth creation, but wealth preservation. If you bought silver 20 years ago, your purchasing power has been maintained despite all the monetary expansion, currency volatility, and economic cycles in between. If you bought silver 5 years ago, you've experienced significant appreciation. If you bought silver at the 2011 peak, you've experienced frustrating losses and are only now approaching break-even. These divergent experiences illustrate why entry timing matters, but also why long-term holding reduces timing risk. Over 10, 20, or 30-year periods, silver has rewarded patient holders who viewed it as portfolio insurance and diversification rather than a speculative vehicle. The investors who struggle with silver are those seeking quick returns or trying to trade around volatility. The investors who succeed are those who maintain modest, consistent positions as part of broader wealth-building strategies. Think about silver the way you think about insurance. You hope you never need homeowners insurance, but you maintain coverage because the potential cost of not having it outweighs the premium expense. Silver functions similarly in portfolios. You hold it hoping you never need the monetary protection it offers, but you maintain exposure because the cost of not having it during a currency crisis or period of extreme inflation could be devastating. This perspective removes the anxiety around short-term price movements. If silver drops 20% next month, that doesn't invalidate its insurance function. If silver rises 20%, that doesn't mean you should suddenly load up on more. Your allocation should be based on thoughtful portfolio construction, not market momentum. Looking forward, several long-term trends support silver's fundamental value proposition. The global transition to renewable energy will continue for decades. Solar panel demand isn't going away. This creates a structural floor under silver demand that didn't exist in previous cycles. Electronic device proliferation continues globally as developing economies expand their middle classes. More smartphones, more computers, more connected devices, all requiring silver. Medical applications will expand as global healthcare standards improve and populations age. On the supply side, declining ore grades and increasing production costs will persist. Easy-to-mine deposits are mostly developed. Future supply will be more expensive to produce. These long-term trends don't guarantee rising prices every year. They suggest that over extended periods, silver demand should support higher real prices than we've seen historically. But higher over time includes volatility, corrections, and frustrating periods of stagnation along the way. Disciplined investors prepare for multiple possible futures, rather than betting everything on one outcome. Let's consider several scenarios and how you might respond. Scenario 1. Silver appreciation continues steadily. Industrial demand remains strong, monetary conditions stay supportive, and prices grind higher over coming years. In this scenario, your primary challenge is avoiding overexposure. As silver appreciates, it will represent a growing percentage of your portfolio. Periodically rebalancing, selling a portion of your gains, and reallocating to other assets maintains appropriate risk levels. The mistake here is getting greedy and letting silver dominate your portfolio because it's performing well. Scenario 2. Silver experiences a sharp rally followed by equally sharp correction. Prices spike on speculative enthusiasm, then crash when momentum reverses. In this scenario, discipline becomes everything. Taking profits during the spike requires acting against the crowd. Avoiding panic selling during the crash requires emotional strength. Many investors experience both mistakes, holding through the spike thinking prices will go higher forever, then selling in despair during the crash. Scenario 3. Silver enters an extended consolidation period. Prices move sideways for months or years, creating frustration and testing your patience. This scenario challenges your conviction. When nothing is happening, maintaining your position feels pointless. The temptation to sell and deploy capital elsewhere becomes strong. But extended consolidations often precede major moves. Selling during quiet periods means missing the eventual breakout. Scenario 4. Industrial demand weakens unexpectedly. Solar technology advances, reduce silver requirements, or alternative materials replace silver in key applications. This scenario would fundamentally change silver's outlook. Your response should be reassessing your thesis honestly. If fundamental demand drivers have been invalidated, reducing exposure makes sense. Stubbornly holding when circumstances have changed is a mistake. Scenario 5. Broader economic crisis triggers forced liquidation across markets. Silver falls alongside stocks, bonds, and other assets as investors raise cash. This scenario tests your understanding of silver's role. Silver isn't perfectly crisis-proof. During liquidity crunches, everything gets sold. But silver typically recovers as the crisis evolves and monetary response kicks in. Panic selling during the initial crisis usually proves costly. Scenario 6. Inflation accelerates beyond current expectations, driving intense demand for hard assets, including silver. This scenario could produce dramatic price appreciation. Your challenge becomes managing success, taking profits appropriately, avoiding overconcentration, and resisting the urge to believe prices will rise forever. The best approach to these various scenarios is having predetermined response plans. Decide now at what price levels you might take partial profits. Decide now what fundamental changes would cause you to reduce exposure. Decide now how you'll respond to sharp declines. When scenarios actually unfold, emotions will cloud your judgment. Predetermined plans help you act rationally when everyone around you is panicking or celebrating. We need to discuss discipline directly because it's the single factor that most determines investment success. Knowledge helps. Understanding markets, reading analysis, studying fundamentals, all valuable. But discipline determines whether you actually apply that knowledge when it matters. Discipline means buying when you're uncertain rather than waiting for perfect certainty that never arrives. Discipline means holding when prices are falling and every instinct screams at you to sell. Discipline means taking profits when prices have run up and your emotional attachment wants you to hold for even greater gains. Discipline means maintaining your strategy when everyone around you is doing something different. This is extraordinarily difficult. Humans are wired for pattern recognition, social conformity, and loss aversion. These traits helped our ancestors survive. They destroy modern investment returns. You'll see silver rise and feel regret for not buying more. You'll see it fall and feel fear about further losses. You'll read predictions of silver reaching $300 and feel excitement. You'll read warnings of crashes and feel anxiety. These feelings are normal. Acting on them is usually wrong. Discipline means acknowledging the feelings, then acting according to your predetermined plan anyway. How do you build this discipline? Several approaches help. First, reduce the frequency of checking prices. If you check silver prices multiple times daily, you'll trigger emotional responses to normal volatility. Check weekly or monthly instead. Second, write down your investment thesis and review it periodically. When you're tempted to make emotional decisions, review why you bought silver in the first place. Has that rationale changed? Third, automate where possible. If you're dollar cost averaging, set up automatic purchases. Remove the opportunity for emotional interference. Fourth, maintain perspective. Silver is one component of your financial life, not your entire strategy, not your identity, just one tool among many. Fifth, find accountability. Discuss your strategy with a trusted advisor, family member, or friend who will ask hard questions and challenge emotional thinking. Sixth, study your past mistakes. Every investor makes errors. Learning from them is what separates those who improve from those who repeat the same mistakes for years. Seventh, accept that perfect decisions are impossible. You won't buy at the bottom. You won't sell at the top. You'll make mistakes. The goal is making fewer mistakes and smaller mistakes over time. Discipline isn't something you achieve once. It's something you practice daily in every decision throughout your investing life. The investors who build lasting wealth aren't the smartest or the most informed, they're the most disciplined. We've covered substantial ground today. You now understand why silver is behaving differently than it has in decades. You understand the industrial demand transformation, the supply constraints, the macroeconomic context, and the psychological traps that destroy wealth. More importantly, you have frameworks for making rational decisions about silver regardless of what happens next. Will silver continue appreciating? Possibly. The fundamental drivers suggest higher prices over time. Will silver experience sharp corrections? Almost certainly. Volatility is inherent to this market. Will silver make you wealthy quickly? Extremely unlikely. Building wealth requires time, diversification, and productive assets, not speculation on commodity prices. Should silver be part of your portfolio? For most investors, yes, as a modest allocation, providing diversification, inflation protection, and exposure to industrial growth trends. Here's what I want you to remember above everything else. Silver is a tool, not a solution. It can enhance your portfolio, it can provide insurance against certain risks, it can offer exposure to important economic trends, but it can't replace sound financial planning, it can't substitute for living below your means, and it can't overcome poor decision-making in other areas of your financial life. Approach silver with respect for its volatility, appreciation for its unique characteristics, and discipline in your execution. Avoid the hype, ignore the fear-mongering, think long-term, act rationally. Whether you're holding silver currently or considering your first purchase, base your decisions on facts, strategy, and your personal circumstances, not on emotion, speculation, or what everyone else is doing. The investors who navigate silver successfully are those who maintain perspective, exercise patience, and never forget that their financial future depends on many factors beyond any single asset's performance. Silver is rewriting certain rules of the financial market. Industrial demand has created dynamics we haven't seen before. Supply constraints are real, monetary conditions remain unusual, but the fundamental rules of investing haven't changed. Diversify thoughtfully. Invest only capital you can afford to hold long term. Maintain discipline during both advances and corrections. Focus on your overall financial picture rather than obsessing over individual positions. Take profits when appropriate. Rebalance regularly. Stay informed but avoid information overload. Plan for multiple scenarios rather than betting everything on one outcome. And perhaps most importantly, remember that successful investing is a marathon, not a sprint. Silver will experience incredible days that make you feel brilliant for owning it. It will experience terrible days that make you question everything. Both are temporary. What endures is your strategy, your discipline, and your commitment to building lasting financial security through thoughtful, rational decision-making. Thank you for your time today. Stay disciplined, stay informed, and stay focused on what actually matters in your financial life. The opportunities are real. The risks are real. Your success will depend on which you respect more.